Hi everybody and welcome to this Master Investor webinar with me, James Faulkner, and with the Master Investor himself, Jim Mellon. Welcome to the show, Jim.
Hi James, nice to see you.
Nice to see you too. I'm delighted to say we've got a great turnout today, and it's great to see that you've all prized yourself away from the wonderful weather to listen to Jim today, so I'm sure he's very flattered. I'm going to pass you over to Jim in just a moment for the presentation. But just to say, we'll be doing a Q&A at the end. So thank you everybody for all your questions, and we'll try and get through as many as possible. But obviously we do get quite a few, so apologies for those that we don't get to. So without further ado, over to you, Jim.
Thank you, James. So I'm trying to share my screen. Here we go. I should be a master of Zoom by now, but as always, things take a bit more time. I'm in Dubai, everyone, and it's very hot here. It's kind of knocking on 40 degrees Celsius in the heat of the day. But my most recent piece that I wrote for Master Investor, which came out this week, was about just how interesting and attractive I think the UAE is as a hub for investment. And if their stock market becomes broader, it's certainly something that we all at Master Investors should be looking at. I've bought a flat from a developer called MR, and they're listed actually, and they have a dividend yield about 11 times earnings. It looks interesting, and I'm going to dig a bit deeper. And as I said in my piece, I'm going to update everyone with further thoughts on that. But the investments I'll be talking about today are more prosaic in markets that we're all more familiar with. I've got about a 20-minute presentation, and then it'll be back to James to conduct some Q&A for us. The interesting thing is that we're in a bit of a dichotomy at the moment. As everyone knows, the markets are apparently still quite strong, but beneath the waves, there's a lot of paddling going on, a lot of sector rotation. The tech stocks that were very strong have lost momentum. Cyclical stocks that at Master Investor we were recommending in the last few months have done very well. And there's a lot of rotation in markets around the world as well. So you're getting, outperformance in some markets and underperformance in others. And there's a reason for this. And I'm using the Goldilocks analogy. So on the surface, it all looks like we're in a Goldilocks scenario. But I don't know if you guys saw this week that Walter Mondale, who was formerly the vice president under Jimmy Carter and then ran for president against Ronald Reagan, he was absolutely trounced. He only won 2 states. But his famous catchphrase was, "Where's the beef?" And as I'm using, "Where's the porridge?" If you look at markets with a laconic eye, like I do, it's difficult to see, very vast swathes of value anywhere, really. I found some stocks that I'm going to talk about today, and I think they represent good value and probably do quite well. I hope they'll do quite well anyway. But generally speaking, markets are pretty well priced for perfection, especially in the United States. And although it looks like a Goldilocks scenario with recovery, vaccination rates in some countries, particularly the US and the UK, Israel and so forth, and the UAE, where I am at the moment, being very, very good, the anticipation of good, strong economic rebounds has already taken place in many cases. So I don't really see tremendous upside in markets. And that is amplified by the fact that we're also seeing a divergence in monetary policy around the world. And the 2 starkest examples of that are between China, which is the #2 economy, but catching up relatively quickly, with the US, the #1 economy. The Chinese have taken the view that they need to tighten the creation of money and credit. to avoid inflationary pressures and to make the yuan, their currency, stronger so that it becomes more attractive for use in the pan-Asian world. So it becomes the Asian reserve currency, supplanting the dollar. And indeed, they're talking about a digital yuan as well, which would be really a first in the world, sponsored by a major government. So they're tightening, and that's having an interesting effect in China because you're getting some non-bank lenders feeling the strain, some property companies in China feeling the strain. But overall, China, being a sort of quasi-command economy, is able to do that and take the pain of tightening. Whereas in the United States, they're printing money like drunken sailors. And, not a week goes by without Biden announcing another trillion there, another trillion here, vast amounts of expenditure. Some of that expenditure is needed in infrastructure where the roads and bridges in the United States are really in poor shape. But some of it is not needed. I mean, he sent out checks to basically every adult in the US of $1,400. Americans, not all of them, of course, because there's huge inequality in America, but Americans are sitting on pretty hefty savings. The rich part of America's got massively richer during the pandemic. They certainly don't need the $1,400 checks. And those checks and munificence generally represent a future liability for subsequent generations. They also represent the threat that the US dollar, hit by the money printing and therefore the devaluation of money, which ultimately always results in a reduction in purchasing power for the currency that's being overprinted. And also by the fact that the US trade situation is probably going to get worse rather than better, that the US dollar is likely to fall from these levels fairly considerably over the next few years. The foreign exchange markets are interesting because they're supposedly perfect markets, but you get very divergent opinions. But my general view is that the trend that we've seen for the last year or so of the US dollar gradually going downwards is going to persist, and we'll see further falls in the US dollar against most major currencies, and particularly against the yuan. So what we're seeing in the United States is massive money printing. At some point, that has to stop because otherwise the US will get very high rates of inflation. And when that starts to stop, then you have China tightening and you'll have the US tightening, bond yields will go up and equity markets will probably react very negatively to that effect. But at the moment, the US, as I said earlier, is printing like, it's partying like 1999. So we have to be concerned that both the US government yields will start to go up in response to this massive amount of debt that's being issued, even though the Federal Reserve is buying a lot of it, and that inflation will and is rearing its ugly head. So there's a divergent mechanism at work in the world today, which has not been seen because we haven't had two genuine superpowers with monetary competence for a very long time. So we're in an interesting and potentially dangerous phase. Another thing Andrew Scott, my friend, sent me this morning, which I thought was very interesting, was that in my whole investment history, and that goes back to the early 1980s, the size of the Federal Reserve chairman has been getting shorter. And you may remember Janet Yellen, who's now the Treasury Secretary in the United States, being a short person, and progressively from Volcker, who was a giant, onwards, the height has been shrinking, along with interest rates. It's not a scientific analysis, but recently the new guy, Powell, is taller than his predecessors, and interest rates have been beginning to go up. So it may just be a foretaste of what's to come, but I thought it was rather amusing that Andrew sent this on. But the thing about inflation is that central bankers may feel that they're on top of the situation, that they know how to manage inflation, but I'm sure that the central bankers from the 1970s, when there was very high inflation in the UK and in the US, thought that they were competent enough to manage inflation as well. But once the inflation genie is out of the bottle, and it is, it's very hard to put it back in. So we as investors, and we've been signaling this for the last 18 months to 2 years, need to take into account what's coming, which is higher inflation. And how are we going to deal with that? And that's what I'm going to talk about in this presentation. Here's a sort of graphic description of inflation. You can see it all around. It's insidious, and the price of services, getting a haircut, the price of a lawyer, the price of, really everything has been going up. And the effective purchasing power of £20 since 1990 is represented by these shopping trolleys. But also, you may notice that when you go and buy stuff that, instead of getting the 38 Ziplocs, you're now getting the 34. So companies are dealing with, rather than raising prices, sometimes they're just shrinking the size of the goods that you're getting. This is inflation, just by a different means. And we are at the point now, some people saying, well, it's going to be a short-term burst of inflation because of all the money printing that's taken place during the pandemic. But I feel that this is going to be the beginning of a fairly prolonged period of inflation, because we are now in this unusual situation where self-inflicted economic depression really is now being replaced by economic rebound, which is extremely strong in some countries. And in the UK, for instance, we're going to have extremely strong growth this year and next year. And that will cause wage inflation, because although there is some slack in the US and British economy and elsewhere in the world, there's not that much slack. And, there's not that many, there'll be lots of vacancies for jobs and not that many people to fill them. So I think we're going to be in a period when we've got to be very watchful for the effects of, as I said, inflation. And I've gone over that far too much, but you can see on this chart that actually the headline inflation rate in the US and in the UK and elsewhere is rising. And I think you're going to see considerably higher rates of inflation. You might even see 5-6% in the US by the end of this year. That might result in the Fed tightening a bit, but it'll probably be too late by then. And the inflation genie, as I said, is out of the bottle. So what do we do about this? Well, the normal thing to do is to buy gold, silver, platinum, palladium, etc. And we have, as you know, been big bulls of those. Gold was really good for a period. Silver's been very good, really, for the last year. It's up 65%. Gold is only up 3 to 5% in the last year, but before that, it did very well for us. And why is this? Well, there are 3 points I want to make. One is that Bitcoin and cryptocurrencies have stolen the thunder of gold and silver, which are the traditional hedges against inflation. And you have to remember that going back for centuries now, gold preserves purchasing power extremely well, and as indeed does silver. And the silver has caught up a lot in terms of its ratio with gold. And the same applies for platinum, palladium. But Bitcoin has come along, and much to my bemusement, I have a friend who's a business colleague who is a big believer in Bitcoin and has done absolutely brilliantly for the company in which I've got an investment, buying and holding Bitcoin, but it's just too scary for me. And I probably lose the key, the number key, which another friend of mine has done for his, what would now be $20 or $30 million worth of Bitcoin. He lost it a few years ago. But it's the thing about gold and silver is that, and particularly silver and platinum, is they have industrial uses as well as being ornamental and designed for hoarding. So I think that we're going to find, and you've seen recently that Bitcoin has fallen in price almost overnight by 20-25%, and the other cryptocurrencies have followed, and they may go back up, they may go back down. There is definitely a shortage in the sense that it's a scarce supply of Bitcoins. But my preference remains with gold. And I feel that now, gold is around $17.90 an ounce. Silver is somewhere over $26 an ounce. I'm pretty sure that by the end of this year, we're going to be looking at 2,200 to 2,500 on gold, and we could be looking at $35 to $40 on silver. Those in themselves would represent excellent rates of return. But obviously, the better way of playing gold and silver is to buy the companies that produce or are about to produce or are expected to produce the metals, and particularly the ones that are well managed. And so I've been loading up on in this slight hiatus period in the gold price, I've been loading up on some stocks and offloading some other ones because they have just gone up too much. And some of the stocks that we've recommended in the last 6 months to a year have done really, really well. I mean, basically everyone's a hero in a bull market, but particularly the recovery stocks that we highlighted in the past few months have done extremely well. I'm going to give you some advice on what you might want to do with that, because there's someone sent in questions in advance of this presentation, said, you often get, investment advisors or pundits like myself giving advice on what to buy, but rarely do they give you advice on when to sell. And I just want to give you some top sizing advice as well, if you've got some of these stocks that I've been, recommending in the past few months. Now, what's interesting to me at the moment? Okay, so I'll start with big pharma companies in the US. We all know that the smaller vaccine producers like BioNTech, Novavax, and so forth have done extremely well because they obviously come from a small base. But Pfizer, for instance, owns half of the rights to BioNTech. Sales of that drug, and they've not done what Astra has done, which is they are making a profit every time they sell a vaccine. The sales will be somewhere between $10 and $15 billion this year, and probably the same next year, because it's likely that we're all going to need booster shots for these vaccines, especially the vaccines are tweaked. So Pfizer is a big company, but nonetheless, the significance of the vaccine is not to be underestimated. And this company is only, about 12 times forward earnings. It has a rock solid balance sheet. It's a very well managed company. It's got a good pipeline, and its yield is just under 4%. So I would recommend Pfizer as one of the big biotech companies, names in the US to buy at the moment. I'd also actually recommend Astra in the UK, although it's not on this list, because it's come under a tremendous amount of pressure. The French president sniping at it. First of all, the vaccine doesn't work according to him, but he still doesn't get enough of it. So, we all know the absolutely appalling performance of the European Union vis-a-vis the Astra vaccine. But Astra is a good company, and I think that it's probably been held down a bit by all this publicity about the vaccine, and the European Union threatening to sue it, and probably will sue it but won't win. So you may want to pick up some Astra in the UK if your principal concentration is in UK stocks. The other one I like is Regeneron. It's become a big pharma company in the US. It's about 12 times earnings. It has strong franchises, particularly in cancer and cardiovascular disease, as well as in the eye. And it's about 12 times earnings, and I think it's a pickup stock. So you should think about buying that. And the idea was that Biden would come in and cut US drug prices, and I think there will be some cutting of US drug prices. But in a world where we've been battered by the pandemic, people are looking more favorably towards big pharma and innovation in biotech generally. So I would recommend that Regeneron this is a new idea, becomes part of your portfolio. Another new idea, it's not new, of course, but this comes really from the banging of the drum by my friend Will Nutting, is Tesco. All right, so Tesco sold off its Thailand business, paid out a special dividend. The share capitalization is difficult to get a grip on because they adjusted the number of shares and all this sort of stuff, had share consolidation. But the bottom line is it's just over 10 times earnings. It's got a fortress-like balance sheet. It's 4% and a bit yield. They'll probably pay more special dividends in due course. It is the absolutely best UK retail company, and it's going to be a cash machine for years to come. And if we do get inflation, the food retailers should continue to do quite well. And so I recommend that. They've also got a very strong online offering, which has been accelerated by the pandemic. And indeed, they are probably the largest in terms of online supermarket delivery. And, you know, you think of the UK, it's a very big economy. It's fifth biggest economy in the world. And yet our biggest retailer is only valued at $25 billion. So it's cheap. I would bank that one away. I have consistently liked Japan for a while now. And, you know, rather than getting into the weeds of which Japanese stock you should or shouldn't buy, the easiest way to do it is to buy the MSCI iShares Japan ETF. I think Japan's got another 20 or 30% ahead of it in the next 18 months, and the yen is undervalued. There's some activity going on in Japan, activism, that you may have read about. That you know, Toshiba is under threat from foreign raiders. This is all good news. And the next one is Melrose. Melrose is a company that buys companies, improves their margins, spits them out. They've just sold a air conditioning company for a couple of £1 billion. They bought GKN. It didn't look particularly good because of the pandemic, but now it looks really good. They are only 15 times earnings. It's a low yield because they're, you know, they're always reinvesting, but they are really, really good at managing companies. And it's around £10 billion in market cap. So I would go for that one. Now, these are some of the stocks that I've already recommended to you. I also recommended IAG. I've taken it off the list because it's done extremely well. And, you know, I'm not really sure that people from the UK will be going on droves to European destinations in the summer. I would expect that the UAE, a few European destinations, and the US will open up for British vaccinated, probably vaccinated passengers. But I don't think the British are in any hurry to open up the corridors to France or Spain or Italy, because I think the British government has a cunning plan to keep people at home spending money in the UK rather than spending it overseas. So I've taken take IAG off this list. As you know, IAG is the owner of British Airways, among other airlines such as Aer Lingus and Iberia. Allianz, I still like. It's one of the best insurance companies in the world. It's 10 times earnings. It's a 5% yield. It's amazing to me as a German company that there's nearly a 5% rock solid yield at a time when Germans with deposits in the bank are getting negative interest rates. So it's, you know, it seems to me an anomaly, and I would put that in your portfolio. In fact, it's already been a recommendation of mine for a while. I've been a big buyer of Lloyds Bank, as some of you know. Okay, so this is the story on Lloyds Bank. We recommended Lloyds Bank at about 27 or 28p. It's currently 42. It just went a small dividend of 0.7p. I think that Lloyds, my target is 55, but if you've done very well in Lloyds, then I would top slice some of it here. So around 42, 43p. I'd take some of it off the table and run the rest for around 55. As I said in one of my notes or my last Master Investor appearance, you rent bank stocks. You don't, you know, the big, especially the big ones, they're behemoths, they're not particularly innovative. I don't think the threat from challenger banks is particularly strong. That's my own view. But Lloyds will go up and down with the economy. The economy is going to be very strong. Lloyds will have low provisions. And there is sort of quasi new management there, although it looks to be like the big banks just recycle the same people between them. So another 20% upside. Excuse me, I'll drink some water. I recommended, I don't know what happened to my voice. I recommended VW and Porsche. Sorry about this. Some time ago, I've taken VW off the table, but we still got Porsche, and Porsche is the ultimate parent company of VW. I think these guys, the Germans, are going to eat Tesla's lunch, and they're much, much undervalued compared to Tesla and the other electric vehicle companies. pure electric vehicle companies. Indeed, Porsche is only about 6 times forward earnings. I think my voice is returning, thank heavens. And I still like Carnival. It's gone up a lot from the bottom, but I don't know if you looked at the bookings for cruise liners, but they are extremely strong. You know, the people who like cruising are really missing it, and the pricing is going to be pretty strong, and cruising is coming back. So sometime towards the middle of this year, limited cruising is starting in the United States, and Carnival is the best and biggest of the companies, so I recommend that one. I'm still holding Marston's. As you know, just before the pandemic, Green King was bought by Hong Kong interests. Marston's was around £1 a share when I first got into it. It's around £1 a share today, having been down at 20 in the height of the pandemic. But, you know, there's been consolidation in the pub sector. I think someone's going to come along and buy Marston's. They did a very clever deal with Carlsberg, where they vended in their brewery interests into a joint venture with Carlsberg, so they restored their balance sheet. In terms of gold, which I mentioned is a must-have in your portfolios at the moment, I like Barrick. It's the biggest gold miner in the world. I like Kinross as well. They're relatively cheap. They're very efficient, good gold producers. I'm still holding some Venturex. It's done extremely well. It's up about 5 times in the last few months. It's an Australian copper play. It's been taken over effectively by a really veteran guy in the mining business in Australia, which is the reason that the stock has done so well. It's got a huge deposit in Australian copper, and that one, if you've got it, you might want to take some profit here, but run the rest of it. And if you have followed that one and bought into it, you'll have done extremely well. Likewise with Dark Mining, which I haven't put up here at the moment because it's a very small company, but it's done extremely well from a profit point of view, as has Zenith Minerals. They just made announcements about further gold discoveries and activities with lithium in the United States. And that again has done extremely well. So I would continue to run that, and I would look for another double on the Zenith share price. And then the perennial favorite is of course Condor, which I'm a director of and the largest shareholder of. It's getting closer to production. They've announced that they bought equipment so they can produce. That equipment will take about a year to install. They've proven up more reserves. It's a very, very well-run company in my view. And the price per ounce of gold in the ground is excellent. There's downside, it's in Nicaragua, but at the moment Nicaragua looks relatively stable. So those are my recommendations. Now, some of you will be familiar with SPACs. That's been along with Robinhood, GameStop, and all the other excitement at the beginning of the year. SPACs have been the sort of easy way to riches for those who've created the SPACs, not necessarily those who invest in the SPACs. But the SPAC boom is over. It's well and truly over. There are a lot of SPACs sitting there, and I don't know if you know this, but you need to invest in, you need to use the money that you've raised in the SPAC within 2 years, or you have to hand it back to the shareholders. And so all these guys are running around looking for deals, and there aren't that many great deals out there at the right price. So it may be better timing for people to go and negotiate with SPACs to put their companies into a SPAC. But from the point of view of investing in de novo SPACs, I would not do it. It's completely over, that boom. It was a sort of, it was a reflection of the money printing that's been going on and the over-enthusiasm and frankly speaking, rank ignorance of some market participants. And so that's well and truly over. And it may be a signal that the US market is beginning to flop over and that a correction lies ahead, which I think is the case. Now, as you will all know, or most people will know, I've been really keen on alternative protein area, and our company Agronomics has done very well in the stock market. My colleague Anthony Chow and Laura Turner and others who've recently joined done a great job in terms of getting us to the forefront of cellular agriculture, and my book came out quite recently on the subject. I think this is an enormous industry. The total addressable market for dairy, seafood, meat and the other materials that can be produced in laboratories and are being produced in laboratories like leather or threads or collagen is over $5 trillion, which is twice the size of the UK economy and makes the electric vehicle market look rather puny by comparison. This is going to be a massive market, and I'll just tell you my predictions right now. Number one is the dairy industry as we know it will have gone in 10 years' time. Already a quarter of the US milk market is alternatives, and they're all plant-based, but as soon as the precision fermented milks, which are exact replicas of milks without any cow involvement, come along, and they're very close to the market, then the established dairy industry is dead. And you can make up your own mind how you're going to play that. One way is to look at New Zealand. Their milk producers are the largest companies on the New Zealand Stock Exchange. If you're brave, I would look at shorting some of them. Fonterra is the biggest of them. But the milk market is gone. In 2030, about half the meat market, and I make this, this is not a fanciful prediction, will be either plant-based or cell ag-based. And similarly, about half the seafood market will be made in laboratories or industrial plants. And our company that we've invested in, Blue Nalu, which is in the agronomics portfolio, is the world leader in that area. So I'm very, very big on this. As yet, these companies are not particularly highly valued. And there's lots of white space opportunity. In other words, creating new companies in the area, licensing opportunities, carbon trading opportunities, because existing food production is highly carbon emitting, but the new alternative companies should get carbon credits. So there's an opportunity there as well. So Anthony and myself are working very hard to expand our footprint in the area. And I'm very pleased to say that agronomics and our own interests are now the world's biggest investors in cellular agriculture. And we want to maintain that position because, whatever, people say, and, there are always two sides to arguments. The bottom line is that animal husbandry is the biggest producer of greenhouse gas emissions in the world. It's a real threat to our human health because 80% of antibiotics go into farmed animals, and God help us if we get a bacterial pandemic as opposed to a viral pandemic like this one. It would make this one look like a walk in the park, frankly. I'm motivated by reduction in animal cruelty, and anyone who's watched Seaspiracy, the Netflix documentary, or Kiss the Ground, the other one about the beef industry, will know exactly what I'm talking about. But there are many reasons why we need to reduce intensive farming in the world, and I think that this will be encouraged, particularly as we go into COP26, which is the big show in Glasgow at the end of this year, when also the Longevity Forum will be taking place, funny enough. So, just keep looking at that sector. I think some of the companies in that sector will go public. We've already had Beyond Meat, which is obviously a plant-based company, going public. Oatly has announced it's going public, probably at a $10 billion valuation. Impossible which is the big rival of Beyond in the United States, is rumored to be going public, again at about a $10 billion valuation. But when we start seeing the cell ag companies going public, we're going to see some real fireworks. So just keep an eye on that. And then lastly, I just want to update you on Juvenescence. I know Juvenescence is a private company, but it will be going public at some point in the not too distant future. And the great news is that our first product has gone on the market in the United States. It's called Metabolic Switch. It doesn't taste very nice, but as you will remember from your younger days, medicines weren't supposed to taste very nice, but it's ketone ester fuel. It's highly potent, puts you into ketosis without having to do the diet. And it's now on the market in the United States, and I think it will do extremely well. And so that's the first product from a large number, hopefully, that will come out of the Juvenescence family of companies in the next few years. It's definitely one to watch when there are some further announcements about a public offering in Juvenescence. Some of the investments in Juvenescence have done extremely well. So, and that will provide further fuel for the fire. And then lastly, a little plug for my book, not because I intend to get rich from writing, because all the profits from this book go to support the Good Food Institute, which is the world's leading advocacy group for, and some of you will have heard Bruce Friedrich talk on Master Investor events. He's a great guy. To try and promote the reduction in intensive farming and the an improvement in human health and environmental health by promoting plant alternatives as well as cell ag alternatives. So if you haven't got the book, please buy it, because it's all for a good cause. So in a nutshell, we're going into a period, as I've been signaling for a while, of inflation. Don't be despondent if you feel that gold isn't moving as fast as Bitcoin. One day it will, and you know, you'll be well rewarded. I think that now is, and just continue to invest more in gold, silver, proxies of gold, silver, platinum. The stocks I've highlighted, I'm sure that the team at Master Investor will be happy to send you a copy of those if you want it. But I think we've got some good stocks there. You don't need a lot of stocks to create a good portfolio. But you know, I think it's time to reduce adventurism. In other words, you know, blue sky stocks, you know, in electric vehicles or flying cars or you know, space and so forth. I think they're going to come to ground, and so literally, so I'd be a bit wary about being over enthusiastic in that area. And as far as cryptocurrencies, look, I honestly, I'm lucky to have made money through my business partner's venture, but it's not something that I know enough about nor feel totally comfortable about in dabbling in myself. So that's a summary of where we're at. And if I'm invited back, I will update you all sometime in the summer. So thank you very much for listening, and I'll hand it back to James to do a Q&A session.
Thanks for that, Jim. Definitely a lot to take in there. Does seem like you're striking a much more cautious note now that you know, markets do look like they might be quite toppy, and we've been getting quite a lot of questions in terms of, you know, whether you do expect a correction to come. I just wonder what kind of magnitude you think that the correction will be, given that, you know, stocks do look priced to perfection, but yet they still are pretty much the only game in town when you look at, you know, the alternatives.
Yeah, I mean, forecasting, you know, exact moves on markets is something I can't do, and nor can anyone else. And if they can, they're certainly not going to be sitting in Dubai with a full schedule of meetings, because they'll be on a beach somewhere enjoying their proceeds. But I would say that, you know, there has been a strong bull market. But as I said earlier, you know, there's a lot of paddling underneath. You know, not all stocks have been going up, not all sectors have been going up, and there's been a lot of rotation. My own view is that we'll have at least a 10 to 20% correction. So at the moment, we're in a pass the parcel game, right? You know, people are, you know, still participating because they think they can eke out a little bit more return. And as you rightly point out, where else are you going to make any money? But you don't want to be the last person holding the parcel. So reduce your exposure really to stocks. And if you do have any stocks, then just be very focused on ones that are resilient.
You've been talking for quite a while now about the return of inflation, and we've got a question from Matthew Lambert, and it's, what is Jim's view on UK interest rates, you know, related to mortgages, and it's all about, you know, is now a good time to borrow and to fix, given that, you know, the price of money is so cheap, so presumably over the long term, you know, inflation is going to erode the value of that debt. Is now the time to lock in cheap money?
Yes. So I was reading something today about the hyperinflation in the Weimar Republic between the wars, and how the man who made the most money during that period, and there was only very few of them who made money, most people were completely wiped out by the effects of inflation. He borrowed vast amounts of money, put it into physical assets and to gold, which he hoarded in Switzerland so he could avoid taxation in Germany, and he ended up as a very, very wealthy individual. I don't know what happened to him, you know, in the subsequent Second World War, but anyway, that he was known as the guy who made the money in the hyperinflationary period. And I don't think the same strategy is out of place at the moment. If the banks are prepared to lend you money on a fixed rate for very low interest rates over a long period of time, you know that in periods, I'm not talking about hyperinflation, but 5, 6, 7% inflation, that the real assets outperform, bonds as an example, in those periods, and that would include probably property. So if you're borrowing to buy property or real assets, then it's probably a good strategy.
And I suppose it depends how benign the inflation environment is, doesn't it, as well? Because during the 1970s, we had really high inflation, and stock prices actually did really poorly, didn't they, in real terms, during periods during the 1970s. So I suppose it also depends where you put the money, doesn't it?
Yeah, I mean, in the 70s, not that I was managing money then, but in the 70s, you had interest rates, I think in the UK, they're up at 15% at one point, and in the US, maybe even higher. And of course, the effect of that is to crunch the economy. So the reason that stock prices did badly is that the companies couldn't make any profits because their borrowings and consumer demand for their products were highly, under threat, basically. And but I don't see that happening at the moment. So I would take a sort of I take the view that we could look at. I mean, also there's definition of inflation. What is inflation? Is it properly measured? Probably not. We all know that if you go back 10 years and you think about have prices gone up? You might look and think, well, they have for me because the price of my cleaner has gone up, the price of my trip on the tube has gone up. But the government might say there's been no inflation over that period. And I just think the measurement is wrong. So we have insidious inflation in the UK and in the United States and elsewhere in the world. But inflation we are definitely getting. And I read every day, as you know, lots of economic stuff. And there's no doubt that input prices, which is the price that goes into making goods and services, are going up fairly dramatically at the moment. And China, which has provided a great inflationary relief or deflationary relief to us over the last 20 years, because the price of imported Chinese goods has gone down and down and down, is no longer going to be providing that relief to Western inflation numbers going forward. And by that, I mean, the price of, for instance, clothes or electronics has been going down relative to incomes dramatically because of the effect of China's huge production. We're not going to get that anymore. And so inflation only has one way to go. I don't think it's going to be hyperinflation, but on the other hand, you need to protect yourself. And it really, absolutely no-brainer is to hold precious metals. It's a no-brainer. I can't think of anything better to invest in at the moment. And then if you hold bonds, just get rid of them, because I can't see any upside in bonds. Governments have printed a whole load of money. They're going to have to repay it. What's the best way of repaying it? Inflate it away. They've done it in many cycles in the past, and they're bound to do it again this time. And that effectively is a default, James. If you inflate your way out of bonds, you may not physically default on the debt, but it's a way of effectively defaulting. And so the pensioners and the pension funds and the insurance companies that hold the bonds are going to be stuck with depreciating assets.
You mentioned Brexit and the fact that the UK's managed to have a good vaccine rollout as a result of that.
I didn't mention Brexit. I just mentioned the European Union's lamentable performance. That's not the same thing.
Well, we've had a question on your opinion on Brexit, and it's from Chris Smith. So can I have Jim's opinion on the benefits and drawbacks of the first few months after Brexit? Also, what are the likely subsequent opportunities and the possible threats?
Yeah, well, Deng Xiaoping was once asked what he thought about the French Revolution, which took place in the 1700s, as you know, and he said it was too early to tell. So I think the effects of the first few months, which had been very mixed. I mean, we've had the issues in the Northern Ireland situation, issues with shellfish, rather surly behavior from the Europeans towards the British, possibly to be expected. And then, of course, you've had the pandemic, response on the other side, which has made the UK, having been abominable at the beginning of the pandemic, look extremely good by comparison at the moment. And I think they played a blinder on that one. I don't think we're going to see dramatic effects either way for some time. But overall, I would think there are two factors at play. One is there are stresses and strains in the European Union. They're becoming more evident. I don't think there's, especially with Merkel going and Macron being under threat next year in the presidential election. I don't think he'll lose, but there's, the polls are showing that he might. And I've just been told, by the way, it was not Deng Xiaoping, it was Zhu Enlai, so I got that one wrong. That was Paul Kirkby, he gets the credit for that one. So there are stresses and strains in the European Union, which we're probably better off not to be experiencing. I don't think that, I took a nuanced view on this. I didn't think it was going to be great, really, either way, but make a huge difference. And I don't believe that we should be restricting high quality immigration into our country, and nor do I believe particularly that we have a great deal of sovereignty to preserve, because we give up all sorts of sovereignty, to NATO, to the UN, to the trade alliances and all that sort of stuff. So I just, we just have to make the most of it.
And just to follow on from that, I mean, the UK stock market is still looking really cheap. We had a question.
Well, it's relatively cheap.
Relatively cheap.
Yeah.
So we had a question from Taha Dohad Wire. When are we going to see the FTSE 350 index of mainly domestic consumption stocks outperform? I mean, presumably, if we expect some kind of really big economic awakening after lockdowns lifted, all those stocks are going to do really well.
Well, the FTSE 250 has done a lot better than the FTSE 100, I think, as everyone knows. The FTSE 100 is very highly represented with energy stocks, which have been under severe threat, and banks, which again have been, laggards in performance. The FTSE 250 much better represents the domestic economy in the United Kingdom. My view, you might be better off with a portfolio of banks, especially because as interest rates rise, banks tend to do well. And I mentioned Lloyd's, but you might also, HSBC as another one that's, I think, a good investment. And in contrarian fashion, I've been a bull for the last few months on big oil companies. And so I think BP and Shell remain good buys at this stage. So, if you're looking for consumption stocks, then, what's wrong with Marston's as an example? I think it'll be taken out at some, future date. That's a good one. You can make your own mind up about retail, whether it's going to survive or not. There's what's online and what's not. But if you're going to buy an online, a retailer that's both bricks and mortars and online, I've been pushing Marks and Spencer's for a while, and it's gone up quite a lot. But I still think it's a lot cheaper than Ocado, and maybe one day Ocado will just buy Marks and Spencer's. And remember that half of Ocado's online business in the UK is owned by Marks and Spencer's.
Just to finish off then, Jim, because I know you've got to run quite.
We've got a few more minutes. Yeah.
Question. Well, my question actually. Goldman Sachs recently said that they believe we're entering a new, a rerun of the Roaring '20s. Do you buy that? And if so, when's the Great Depression?
Well, have you gone back and looked at Goldman Sachs's? I mean, I don't want to denigrate them, but have you looked at their previous forecasts? Because I don't think they're very good. I mean, they're very good at predicting their own profit outcomes, but whether their economic forecasts are any good or not is another matter. But look, I mean, the roaring. We are going to come out of this roaring. I think GDP growth in the UK will be, as I've said for a while, much higher than most people think this year and next year. We will next year probably be the strongest growing economy in the G7. We'll certainly surpass the pre-pandemic output probably by the end of this year, and then we'll have a very strong period of outperformance. And it's important to remember that the UK by 2040 will be bigger than the German economy, and that's based on demographic trends as well as economic trends. So we shouldn't talk ourselves down too much, and we're already 7% bigger than the French economy. When I was a child growing up, our income per head was about half that of Germany, and about 2/3 that of France. So it's been a remarkable performance. And there's one person who some people don't like, but I like very much, who's responsible for our transformation, and that's Margaret Thatcher.
Well said.
Yeah.
And on that note, I think we've got a slide to show you.
I think it's a slide of Evel Knievel, isn't it?
Yeah. So yeah, this is for you guys just to take note of. So some forthcoming events at Massive Investor. We've got 3 steps to steady investment growth, and that's with VectorVest on the 27th of April. And we've also got Ask Evel, which is a Q&A with me, and that's on the 13th of May. So dates for your diary. Also, you can sign up for those at events.masterinvestor.co.uk. And also don't forget to share your feedback with us. So yeah, look out for the survey, which will be coming into your email boxes shortly afterwards. And yeah, I just want to say thanks to Jim for taking part, and thanks to everybody for watching. So take care, enjoy the sun. Bye-bye.
Thank you very much. Thanks, James. Thanks everyone for attending. It's really nice to do these things, and hopefully you'll come back for another one. Thanks.
Good stuff. Bye-bye.